Hi, I'm Rick Brimacombe, and on behalf of the Minneapolis Club, Upsize Minnesota, and my group, Club Entrepreneur, welcome to our workshop on raising capital. Let me start by asking a question. How many of you are currently in need of financing or thinking about raising capital in the not too distant future? Raise your hand. Okay, a whole host of you, so that's good. Well, this event is for you. Financing your business is not an easy task, and the process can be a bit confusing and potentially even overwhelming. If you're not sure about where to turn, we've created this session to help you improve your chances when you're looking for capital. With that said, growing your company isn't always about capital, and there's a myriad of ways in which you can finance your growth. Sometimes it involves outside capital, and sometimes it doesn't. There are many different flavors that you can choose from, kind of like the old Baskin-Robbins 31 flavors of ice cream, or today's equivalent, the Yogurt Lab. To help companies better understand the financing process and introduce you to a group of experts and solution providers, Upsize Minnesota and Club Entrepreneur has assembled today's event. Upsize Minnesota is a how-to magazine devoted to helping business owners build bigger and more profitable companies. Club Entrepreneur and my firm, Brimacombe & Associates, support folks like you by helping you refine strategies, assemble resources, and secure financing. In our efforts to provide actionable content, Upsize Minnesota and Club Entrepreneur offer you today's event, and we're confident that you'll find value in attending. A few ground rules. This is a new presentation format for us. We haven't done it before. So just to kind of let you know what's happening and kind of pave the way for today's event. First of all, we're going to cover 18 different options in terms of financing your growth. Second, each one of the presenters is going to be given up to 3 minutes to share a little vignette about their respective financing solution and organization. And lastly, since there's a broad base of categories, let's hold our questions till the end. After each presenter finishes, we're going to join at the end of the event, and the tables to the outside of the room are all numbered with the respective speakers. And so after we finish with all 18, you can go find who you want to talk to and spend a little time one-on-one with them. So again, we'll go through all 18. We're not going to do questions, but you can find everybody afterwards. We have the room for as long as we want. I'll try to have a hard stop at 1, so I'm going to get into the speakers and get you at the tables before 1 o'clock, but nonetheless, we can stay here as long as you want and as long as the speakers want to engage with you all. Okay, so as far as the categories go, and when I was writing this up, it made me feel a little bit like we were doing the Oscars or something. So there's 18 categories, and the categories are angels, angel groups, venture capital and early stage financing, growth capital and recapitalizations, investment banking, the SBA, accounts receivable and inventory financing, customers, so in other words, not growing your company by raising outside capital, growing it organically and on the backs of your customers, crowdfunding, contests and prizes, economic development, family offices, SBIR, franchise financing, revenue-based financing, securities-based financing, and last but not least, vendors. And Steve, I've mentioned to him, one of my favorite subjects here is growing on the backs of your vendors. So if you're a vendor in the audience, I apologize up front, but we're going to tell you how to get better terms from your vendors today. So anyway, those are the 18 categories. Each one is unique. Each one is a valuable tool that you can leverage to try to finance your growth. And we're going to hear, again, some little stories about those folks and what they have done with their category. In terms of trying to keep up with what happens today, it is being videoed and will be up on the Club Entrepreneur website in about 2 weeks. And then Upsize Magazine will be writing about this in the next issue, which will come out in early July. So if you want to get kind of caught up with some of the things that maybe you want to refresh yourself on, those are 2 ways to keep in touch with the event that goes on today. All right, so let's get started. John, why don't you come on up? So John Dienison is at OrthoCore Medical. John recently sold the business and has continued to help them grow. John is going to talk today about angel financing. You can actually have that, put them there, John. It's going to talk about angel financing, and why I picked John is he raised multiple rounds of financing through the worst of the economic recession that we had, through the years of really tough market. And I was continually amazed at every time I talked to him on the phone, he'd talk about, hey, I raised this money and I did this. And the fact that he kept after it, and the market was so bad and he had a lot of success, that I thought he could share a few tidbits with us about how he raised angel capital. John.
So first of all, I'd like to thank, no, I'm just kidding. My name is John Dienison. I got my start early on out in California raising money, equity money from venture capitalists for early stage companies, morphed into a venture capitalist, and then moved back to Minnesota, where I founded my first company, Orthocore Medical. Orthocore Medical has raised $6 million, all from angels, without using brokers or that sort of thing. So literally developed a network here of 80 investors who have all turned out to be happy investors as we were acquired in January. I'm still running the company, and the challenge was we had a new technology. It came out of the Mayo Clinic, but the technology, without getting too technical, was a non-invasive device that was a Class 3 device, if you know medical. So it looks simple, but it actually was a Class 3 device that put an RF field into the joints and was FDA approved for pain, swelling, and arthritis. So not the easiest thing to get investors excited about, as there's some witchcraft, you don't see the technology, it's new, and so really just had to pound and pound and pound. My 2 tips of simple advice is, unlike venture investing, which is all about the documentation and forecasts and financials, you're really just selling on 3 things, and that's the story. You have to have a good story and a believable story, and a story that people get excited about, which brings me to the next point, which is passion. If you're not passionate about it, why would an investor be, right? And people can smell that. And speaking of smell, the third thing that's most important, and especially with what's gone on with Bernie Madoff, there's plenty of money out there, but it's trust. I think I've actually become a better person from raising money for the last 7 years, because people, they can feel with it. They're handing you a check for $200,000 that you could go down to Cuba with. So the final thing, not that I didn't think of that, but
But you didn't.
But I didn't. Final thing is you have to ask. So I had money from the law firm that I was at, from my home family, from my residence up here, and you just have to ask. And nobody's going to be offended by you asking too much. If you ask for $400,000, and the person only has the wherewithal for $25,000, you're not going to offend them, right? It's almost a compliment. So you got to ask. And with that, I guess you can find me afterward on table 1.
And then one last question, the 80 investors, none of those were substantial investors, so it was a lot of modest-sized checks.
I still, I went to Chicago, and we had investors from Chicago, Arch Angel, Frontier Angels, all the way out in California, New York. And the way I looked at it, one professional investment banker said, you came all the way to Chicago and you only got 25 grand? And I was like, I came to Chicago and got 25 grand. I mean, that's a car, right? I always appreciated every dollar, and was able to have a great relationship with my investors because of that.
Great. Thanks, John.
Thank you.
So our next category is going to be angel groups, and Chris Simmons of Welsh and Colliers is representing the Sagas Club, which is an angel group that I'm a part of, and do this with Chris. Chris and John Francis got the group going a couple of years back. It's morphed a little bit. So Chris is here to tell us a little bit about the Sagas Club, the angel group that I'm a part of and that Chris helps run. Chris.
Absolutely. Thanks, Rick. So about 7 years ago, John Francis, and I don't know if you know John, but his dad started Cost Cutters and started that in, I believe it was West St. Paul, and grew that into a large company around the country. Him and I were talking, and in my background at Welsh companies has been working with tenants such as Caribou Coffee, Chipotle, Lee Chin locally, and some of the larger big boxes like PetSmart and Total Wine. But we were talking about different circles, and his circle was in franchise development and franchise, I would say, people that he deals with, and I was in the corporate retail and restaurant side. So we sat down and we just put a little group together initially called MNBOG, Minnesota Business Opportunity Group, and what we wanted to do is connect people. So instead of trying to start a formal organization where we were advocates for any particular deal, we wanted to have a platform, and the platform allowed people to get up on stage and do their own wares for about 20 minutes, and then the audience could ask questions. And so after that was up, we'd go to the next one. So our typical quarter meetings are about 60 to 100 people. I would say probably closer to 60 of qualified investors that come, and other angel networks, because again, we're not being an advocate for the deal. What Rick and I and John do is try to sift through deals. So we'll have real estate deals, we'll have web-based deals, we'll have a restaurant deals, we'll have, say, Procter & Gamble fly in and talk about Mr. Tide, and they're looking not to raise money, but they're looking for franchisees. So we'll have all those type of people in a room, and we'll able to see a lot of different varieties. So what you get from the Sagas Club is an opportunity to get up on stage and actually talk about what you're trying to raise and what your vision is, and try to connect with people in the group. We don't charge a fee or get equity. Rick and I and John, the actual presenters come up. They actually pay for the room, and it's here at the MAC once a quarter. And it's been fairly effective. Again, real estate funds, retail, web-based companies. And what we do is try to, the three of us, sift through and get 4 good presentations every quarter, and a variety of presentations to help these people out and connect each other. So again, a little bit about the Sagas Club, and if anyone has any questions afterwards, I'll be at
Table 2.
Table 2. All right, thank you.
Thank you.
All right.
And then, thanks. A couple of other local angel groups. There's Twin Cities Angels, there's Gopher Angels, the Sophia Fund, the Network Connect. There's a variety of different kind of organizations of folks and a way to tap into groups of angel investors. Okay, so that leads us up to number 3. David Dalvey of Brightstone Venture Capital is here to touch base on the venture capital and early stage financing bucket. David and I have known each other for probably at least 20 years, back when we both had dark hair. Anyway, so David, tell us a little bit about venture capital and early stage financing.
Thank you. Entrepreneurs always ask, how can I get venture capital? And I want to go back and say, why would you ever want venture capital? But seriously, do you really need venture capital? Do you really want venture capital? Because the stark reality is that really less than 1% of entrepreneurs will really ever get there. And it's about 0.5% of entrepreneurs that seek it really ever get to venture capital. So let's talk a little bit about what the venture capital market is. Every year, according to the SBA, there's about 600,000 for-profit employing companies that are formed, about 600,000 of those. 60% of those are funded by owner capital and reach cash flow without ever needing any money. 25% of them are funded by credit card debt and get to operating cash flow, never need any money. Another 12% are sort of friends and family, rich uncles, reaching cash flow, never need any money. So only 3% of the companies that get formed every year ever really get to the venture capital market. Now, the traditional venture capital market everybody thinks of is the Sand Hill Road, Boston guy, VC firms. That is a very consistent, surprisingly consistent 4,500 deals a year that really get to those kind of VC companies. And every year, these statistics around, and come see me later and I'll show them, but every year there's about $30 billion annually that go into these 4,500 deals. And the last 2 years, however, it's been $50 billion and $60 billion respectively. Deal size is getting larger, the deals are getting, so the mainstream VCs are kind of upscaling. They're going to mid and later stage deals. The Ubers, the Planters, the Instacarts, these huge deals with billion-dollar valuations, they've really moved out of the market that we all play in, which is, the early stage growth. So also the number of active venture funds, if you go back and look at where they were in 2002, there were about 1,200 active funds. That went down to about 300. You went through a very bad cycle in the venture world. So by 2012, there really were only 300 firms. So as we sit today, the traditional venture capital world is about, it's increased a little bit, it's about 550 firms managing about $200 billion. Very hard to get to these guys. So the question is, who else is funding the rest of these deals? And I'll give you 3 other sources, if I can get my screen to work. So angel investors fund 16 times more companies than venture companies. Last year, there were 73,000 startup businesses invested, and the angels invested $24 billion in those. That's up from $19 billion and 52,000 deals in 2014. So, angels invest a significant amount into what sort of our market for early stage companies. Corporate venture investing has been up dramatically. Last year, $7.5 billion was invested in 1,100 deals. It's about 17% of the total dollars in venture capital. Companies like Google is actually the largest corporate VC in the world. They do about 300 startups, almost a year. I think it's probably in the last couple of years they've done 300 startups. But there's a trend towards strategic investing is significantly up. Crowdfunding has also emerged as a player. Last year, $2.6 billion was invested through equity crowdfunding platforms. That's expected to exceed $6 billion this year, up dramatically. In 2013, I think it was $400 million, and then the year before, or the year after that, it was about $1.1 billion. So that's developing into a very, sort of stable platform for certain businesses that are easy to understand, businesses that, you can sell pretty quickly. It wouldn't be a technology company, but in a consumer product company would be, crowdfunding would be a very good option. So sort of to summarize, you have 4,500 companies with $30 to $50 billion in traditional VC funds. It's the largest pool of capital, but it's the most competitive. There's about 500 active investors. They're easy to find, very hard to convince to do your deal. Angel investors, again, 73,000 deals, $24 billion. There's actually 316,000 active angel investors, according to the Angel Capital Network. Greatest number of deals. It's more difficult to find some of these angel guys. Corporate VC, 1,100 deals, $7.5 billion. It's a growing option, but you'll have strategic concerns. Do you share some of the proprietary things about your business with a strategic? It can make funding later on difficult. And crowdfunding, $2.6 billion. It's a very viable option for a lot of companies, and it's growing. I think crowdfunding is around to stay. Somebody else was talking about that.
Great.
There you go.
Thank you very much. So David will be at table 3, so thanks, David. So Keith Bears of Convergent Capital, who will be at table 4 afterwards, is here to talk to us about growth capital and recapitalizations. Keith and his firm Convergent Capital have been in the market for a long, long time. So thanks for joining us, Keith, and tell us a little bit about the growth capital market.
Sure. We're a little bit later stage investor than the folks you heard from so far. So we provide capital to companies that are generally, they've gotten to close to 10 million in revenue, up to 100 million, and looking for capital either for growth, to buy out a passive owner who's retiring, other recapitalizations, to make acquisitions, those types of things. Some examples are we provided the capital for Keurig Coffee to build the home brewer that a lot of you have today. They were a little $10, $12 million company. They had a big institutional brewer. They had this crazy idea to build a little home brewer, see if that would work, and so we provided the capital for that. Companies in town, Restaurant Technologies, again, Multiband Corporation, Progressive Rail down Lakeville, all companies in that $9, $10, $11 million range that needed capital for growth, and so they came to us. We tend to invest in the form of subordinated debt or equity. Subordinated debt is junior secured to the bank debt, so the company will take as much bank debt as they can get because it's much cheaper capital. And then if they need other capital, the choice is raise equity and give up part of the company or use subordinated debt if we're comfortable with the company, the management team, and the balance sheet. So quite a bit later stage than the earlier companies. We tend to invest $3 to $12 million per transaction. We've invested about $300 million in 70 plus companies, a lot here, but across the country over the last 18 years. So I think that's a quick 2 minutes on that.
Sure. So Keith, what's kind of the one thing that gets you and your firm most excited about, and what folks in the audience should keep in mind?
It's really good management teams a lot of the time. And it's a good business with growth prospects. Our capital is a lot more expensive than bank debt, so the company really has to have the prospect to continue to grow. But for an entrepreneur, if they have a choice of giving up part of the company in equity or using subordinated debt, if they really can grow, ours is much cheaper because in the end, they keep control of, 100% of the company, even if they have to pay out a warrant for us at some point in time. So we also have done quite a few deals in the recapitalization space, as I mentioned, where one owner is buying out a partner who's retiring, or the management team has a chance to buy out the owner, those kinds of situations as well. And those are, those can be a lot of fun, and we've worked with a lot of great companies over the years.
Great, thank you.
And we're at table 4.
Talking about investment banking is Tom Nemec of Oak Ridge Financial. Tom and I also go back a lot of years. I've worked on projects together. And on table 5 a little later will be Tom. But Tom, tell us a little bit about the investment banking world.
Thanks. Oak Ridge Financial is a firm of about 60 employees out in Golden Valley. We have about 40 individuals that are brokers or wealth managers that will participate in private placements when we're doing it. Typically, a private placement that Oak Ridge does might be a $3 to $8 million equity raise. And I just want to, Dave gave you a little bit of history about venture capital and the trend there. The trend in private capital, when you look at the stock market today being at record levels, I think the general feeling is private capital ought to be easier to get. But back in 1996, we did 26 IPOs in the Twin Cities. Last year we did 1. The year before that we did 1. And the problem with that when it comes to doing private financing is back in the 90s, private investors might think in terms of a 2 to 3 year holding period before they'd have a liquidity event. Now they probably think in terms of 5 or 10 years. So if you've got $1 million that you can invest in private companies, divide it by 2, you can put $500,000 a year in. Divide it by 10, and you can put $100,000 a year in. So the amount of money that individual investors can really commit on an annual basis to private financings is down dramatically. Plus, a lot of the individual investors that might have been participating in private placements in the past are no longer participating. So we have fewer investors investing fewer dollars, makes it a lot more difficult to get a private placement done. And the need for capital isn't any less. In fact, given the trend in IPOs, it's even greater to get a company to the point where it really can afford to do an IPO or get sold. So I'm not telling you that we can easily do them, much more easily than you can. They're still very tough to get done, but we do private placements. We're just starting one now on a medical company. But before you go out to do a private placement, it's very, very important that you really have it well thought out, that you meet with a lot of people to help give you advice on how to go about going to market and be prepared to have a challenging process.
Well, with that, Dave Breitner. No, seriously though, save it for a topic for another day, but the government hasn't helped things by raising the bar.
Well, okay, I did actually meant to mention that, now we do have the Jobs Act, which includes the Reg A plus. And there's a Tier 1, a Tier 2. And the Tier 1, 20 million and under, is going to allow companies to do IPOs with a lot less regulatory oversight. I don't know exactly how that's all going to roll out, but my hope is that what we see are enough IPOs getting done under Reg A plus, and back when I started in the business, they were all Reg A's. Reg A back then was a $500,000 IPO. But if we get enough IPOs done through the Reg A plus regulation, then private placements will be a lot easier to get done, because now we'll have a shorter timeline, we'll have another option for an exit for investors that are investing in private placements, and I think it could actually make that whole process a lot better.
Okay, and thank you, Tom, and you'll be at table 5 later. Thanks.
Thank you.
So covering the general banking categories, Melissa Johnson of Highland Bank. Melissa and I have also interacted on a number of different fronts, and it's been a honor and a privilege to interact with her in the business community, and that's why she's up here today. So tell us a little bit about the banking world.
Absolutely. Good afternoon now. My name is Melissa Johnson, and I'm a business banker at Highland Bank. And Highland Bank is a privately held, business-focused bank here in the Twin Cities metropolitan area. I'm speaking on the community banking aspect today. We serve small to medium-sized business entities, and for businesses, we offer conventional and SBA loans, and we often partner with alternative financing companies to get deals done. Community business banks, put this up a little bit. Community business banks focus on loan sizes between $250,000 to $5 million. Our legal lending limit is $10 million, although we can handle more through bank-to-bank loan participations. When granting a loan, business bankers focus on repayment ability. So as business owners applying for a loan, you need to be able to know and articulate to your business banker exactly how you're going to pay the loan back. Bankers compare your business to others in your industry, and we look at items such as liquidity, cash flow, leverage, retained earnings, total net worth, and equity. And if you don't have any equity in your company, it's pretty difficult to get a conventional loan. A common question we get asked when we sit face-to-face with a business owner is, how much can I borrow? Again, emphasizing repayment ability, banks measure a company's performance based on cash flow. So we look at what we refer to as a fixed charge coverage. And businesses need to have a fixed charge coverage of 1.2 or greater the last 2 out of 3 fiscal years in order to qualify. And I can get into the calculations if you're interested in the numbers and how we look at the ratio and the treatment of extraordinary expenses at my table. But simply stated, it's for every $1.20 of EBITDA, you need to have less than $1 of fixed charges. When looking at a new loan request, we apply the projected debt service coverage to your existing operations and determine if the new debt level can be supported. We can incorporate augmented earnings in various scenarios, such as if you're buying another company. And we also work with you analyzing what your break even is. As you know, banks also have advance rates on different type of collateral being pledged. For example, we lend up to 80% of accounts receivable 0 to 90 days. And I can get into other forms of collateral and their corresponding advance rates again over at my table. So also, as you know, a potential drawback to conventional financing is that on larger loans, typically those above $500,000, there's covenants in place. And these are financial metrics that banks are required to have through government regulations, where we measure companies' performance on a periodic basis. So a quick note on the pulse of the market, interacting with my clients on a daily basis and talking with other community bankers. The majority of our clients overall were able to successfully recover from the 2008 through 2011 recession and are growing smarter and leaner. Today, industries that are doing well, for example, are medical device, assisted living, precision manufacturing, and technology. Conventional lending is competitive, and Highland Bank is willing to get creative on pricing and structure to earn your business. Over the years, Highland Bank has been able to reserve a good amount of capital, and the vault's full. So if you want to visit with me, I'll be at table 6.
The vault is full. Thank you, Melissa. All right, so the next category is the SBA. Come on up, Patrick. So Patrick Grindy of the Strategic Business Group is going to tell us a little bit about the SBA. Melissa mentioned that they do SBA lending at their bank, as do other banks. One of the reasons that I thought Patrick would be a good one to talk to today is Patrick acts kind of like a shepherd, for lack of a better word, to help folks through the process. So tell us a little bit about the SBA, Patrick.
Okay. First of all, we formed our company, Dennis Campbell and I, in 2000. We work nationwide. We help businesses get financing. There's two kinds of loans. One is a conventional unsecured loan, so there's no SBA guarantee behind it. Most small businesses, especially those starting up, do not qualify. So you get a loan from with the SBA guarantee. The bank has had 25% of the loan amount at risk. 75% is guaranteed by the SBA if the business were to fail. There's a little caveat in that, though. If the banker doesn't jump through all of the hoops in the very beginning, and then there's a failure, the SBA will come back and reduce the guarantee from 75 to 0. But typically, it's less than that. You know, they'll drop it to maybe 50%. So what we do is, first thing we do is we'll have you enter an engagement agreement. All that is, it's a contract. It just says, this is what we'll do, this is what you'll do, this is the outcome. First thing we'll try to do is qualify you. Do you have the money to put into the business? Is the business currently operating? Is it profitable? If not, why not? Because if we can't figure out what it is, there's no sense in you going to a bank because they're not gonna fund it. The banks are very conservative today. They do not like loan losses. There was a few years ago when they were more liberal, and they got hauled in by the FDIC and the comptroller of the currency, and they became more conservative. So what we'll do, we'll first kind of qualify you to see if we think we can get you financed, whether it's a startup business or it's a turnaround. Now, we do some turnarounds, and I'm persona non grata at one of the larger banks in town because they had to take some serious write-downs in the 7-figure amounts. So I'm not welcome there, I guess. But that's all right. It benefited our clients. So basically what you need, you have to have some cash in the business. Typically it's about 20 to 25%. If it's a franchise business, you can get by with as low as 15. The difference between a new business and a franchise business is a franchise business is a proven business model. If you're starting your own, you have to prove, as some of the other speakers said, you know, how can I make money? Where's my target market? How much money do I have in it? Who's my competition? You have to find all that out. Whereas in the other market, with a franchise type business, that's given to you. That's what you paid for to get your franchise. So that's basically how we do it. We work nationwide. We work with all kinds of banks. At the risk of being stoned afterwards, I will tell you that if you have a business plan and you go into your friendly bank and you meet this individual, and they'll tell you right away, we're just waiting for you to come in so we can loan you some money. And you hand them your business plan, they look at it, they'll ask you some, you know, relatively easy questions and that. And they say, you know, and they'll talk to you. And the next thing they're going to talk to you about is opening a checking account, savings account, safety deposit box, all those other kinds of things. Now, if you want to find out if you're talking to a real loan officer or not, you ask them one question. What is your legal lending limit at this bank? 9 times out of 10, it's going to be 0 because they're a business development officer. So now you know that what's going to happen is your business plan is metaphorically going to drop downstairs into the credit analyst department. They're going to run the numbers on it, and that will determine if the bank is interested in your loan or not.
And you help them with that process.
We help them with the process.
Right.
We'll go through that. You'll know if you're going to qualify or not before you get to. We won't waste your time or your money.
All right, and you are at table 7, which is over here on my right. Thank you, Patrick.
Welcome.
Okay, next up, Kathy Sadaka of Sage Business Credit. Kathy's going to talk to us about the accounts receivable and inventory financing community. Like Melissa earlier, Kathy and I have interacted on a number of different fronts and a number of different projects, so it's a pleasure to have you here. Welcome, and tell us a little bit about the AR and inventory financing market.
Thanks, Rick. I am Director of Sales and Marketing at Sage Business Credit and also co-founder. We started about 3 years ago, but I have been in this industry for about 20 plus years. As I think Melissa did a really great job of explaining where you may come up short with the bank. So asset-based lending is a really great solution for a company with a great story, solid assets that just needs a little fuel in the tank. We look at accounts receivable, inventory, sometimes some equipment. So if you have any of those, think about those as options to fund your business. An asset-based lender, a bank will look at your assets also, but an asset-based lender will really help you get the most bang for your buck for the value of those assets. We also can be sometimes a little bit more flexible than a bank, use a little bit more creativity. I know at Sage, we pull in partners, we pull in investors. Sometimes we partner with banks to get you the best deal that's really sort of customized for your specific needs. We work with companies that are brand new right out the gate. We work with companies that have been around forever, that are transitioning from parent to child, kind of everything, private and public. A couple of notes. A really engaged asset-based lender also will really know your business well. They'll understand your business and they should be an advocate for you. They should help you when you need help. Who doesn't when you're starting a business and growing it? And they should also be able to help you transition and find more traditional financing down the road. We all know all the bankers in town. We should be able to help make introductions and steer you towards your next finance home. This is a perfect for manufacturing, distributors, transportation, and business services. I'll be at table 8.
Great, thank you.
Thanks.
Okay, John Brillhart. John, where are you seated? Okay, coming from over here. John Brillhart of Cable Alternatives is going to talk to us a little bit about growing the business on the backs of customers and growing it organically and kind of one customer at a time. And one of the sayings that we always had in the venture world is it's a lot easier to grow your company on the backs of customers than it is to go out and raise capital. Certainly creates credibility and substantiates the claims you are making from the financing front. So John, tell us a little bit about your story and how you've grown your business.
Well, thanks, Rick. I'll add to that. When you're bootstrapping your business, it involves some choices, and so obviously when you've got sources of other capital, you obviously have to deal with outside parties, but generally you've got a little more freedom to work the business as you want to. With self-funding the business on the backs of your customers, you have to be very strategic in how you spend your money and how you spend your time overall. If you're thinking about bootstrapping your business, think about a few things. Number one, consider the business you're in. Can you get to revenue quickly? If you're looking at starting up a medical device firm with very high capital and regulatory barriers and years before you can get to revenue, that's probably not a good candidate for bootstrapping, so be very cognizant of that. Number two, look at what you have to do for your overhead. So I work my business out of my home, and so that's low overhead, obviously, and low inventory as well. And the other thing is look at what you can do to dedicate your time to the business. Are you able to substitute things that you would otherwise put money into and use your time instead to deal with the nuts and bolts? The bookkeeping, the PR, the advertising, the time online, the content building on your website, et cetera, et cetera, et cetera. All things that potentially you would look at outsourcing. Generally, you want to kind of bring in as much as you can because your time is, at some point there's a supply and demand curve on your time, but at least at the outset, your time is relatively free. And the last thing I want to talk about, and the one thing that really helped Cable Alternatives a lot, is how you build your brand, how you build your awareness, and how you market your product. Just to give you a little bit of background, Cable Alternatives, I don't know if you saw me on the news. I was in the front page of Star Trib last year. I was on Care 11, and actually one of my customers happens to be in the room today. But we are the geek squad for people that want to get rid of their cable television, is what it amounts to. And that obviously, as if you follow the news, that's a hot topic, and that was really fortuitous for cable alternatives. And so we got in. I've been in 15 different publications, both locally and nationally, and that's helped build a lot of awareness for cable alternatives. I spent, up until January, I've spent $0 on marketing, and I grew the business from just a few $1,000s in 2014 when I started it to into the six figures in 2015, and so that was really good. But PR is one thing that worked really well for cable alternatives when you're doing sources of marketing. How much time do I have, Rick?
You got a little bit more.
Okay.
I told everybody I'd have a hook, so everybody knows they've got a short leash. So anyway, thanks for asking. You got a little bit more time.
Definitely. You know, if you have the opportunity to engage local media sources, newspaper, television, you know, work that shoe leather. Call those reporters. Call those managing editors. Cable Alternative Story worked really, really well, and so we were able to get a lot of connection that way. The internet, social media. You know, your website. Make sure your website is content heavy. There's plenty of free sources out there to really build, you know, help you, give you advice on how to build your online presence. And really one of the interesting things is customers can be of help. Interestingly enough, I'm standing here next to Rick because one of my customers happened to be the head of a marketing firm, and he kind of took me in and gave me some free advice, and then also referred me to Rick as well. And so your customers can be your advocates as well. Lastly, a couple things. I talked about being cheap. If you've got friends and family, probably my biggest source of inspiration and capital is my wife, who has a stable job.
Thank you, John. So John will be over at table 9 when we're done here. Zach Robbins of Winthrop and Weinstein. Zach, where are you? Coming up over here to my left. Zach's going to talk to us about crowdfunding. Zach has done a great job of identifying this as an opportunity for business and got on the bandwagon early. We did an event here 2 years ago-ish. Anyway, so Zach's a local expert in the crowdfunding space. We heard a little bit earlier from Dave Dalvey when he was talking about early stage financings and crowdfunding. So why don't you go into a little bit more detail? Thanks, Zach.
Thank you, Rick. Thanks so much for having me here today. Crowdfunding is somewhat of a ubiquitous term, which basically refers to the pooling of capital from many different people, typically in smaller amounts. What I'm here to talk about is investment crowdfunding, which basically follows on the backs of the successes seen in the world of Kickstarter and Indiegogo, where billions of dollars have been raised for companies, but in exchange, the contributors never received much besides a t-shirt or a mug or access to an app. So fortunately, Congress got to work in 2012, passed the Jobs Act, which has been discussed a couple times so far today. And it's taken 4 years, but we're finally at the point, literally this week, where the last title of the Jobs Act has been put in place. So what does that mean? We now have all of these various different tools to be able to crowdfund capital. Very similar to the private placements that companies have done for decades, but now you can publicize it. And not only can you publicize it, depending on which avenue you go down, you can raise capital from non-accredited investors. FYI, accredited investors are about 3% of the population. Non-accredited are 97% of the population. So you have this entire constituency, which I'm a part of, sitting on the sidelines that can't participate in deals, can't back companies. Finally, this week, regulation crowdfunding went live on Monday. There's about 24 different websites across the country, which are basically acting as broker-dealers, working with the SEC and FINRA, which are now hosting offerings. Locally, we have Parker here from Saunders Daily, which has been in this space now for the past year. Over the next couple weeks, a law that I worked closely on and helped draft called Minvest, which is basically the Minnesota version of investment crowdfunding, is going to be going live. So we're in this very exciting time where companies can go down the traditional path, which, by the way, there's nothing wrong going down that path, especially if you have a network of angel investors. Or if for whatever reason you can't access the angels, you can't access the bank capital, now you can go after the rest of the population and you can advertise that. So I'm at table 10. I have 2 different documents that I brought. I'd be happy to share with you about planning your offering and the different options within each offering type. So thanks so much for hearing my spiel, and thanks, Rick, for having me.
Great, thanks, Zach. So the next category, we're going to touch on our contests and prizes. Don't have to go back very far to not have this be an option. And Savannah Riesing is going to tell us a little bit about the Minnesota Cup. Come on up, Savannah. And anyway, there's been a whole category of, again, contests and prizes that have emerged over the last number of years, and the Minnesota Cup is probably the most prominent one here in the state, and I've been honored to be involved in that going way back to the beginning. And tell us a little bit about the Minnesota Cup, Savannah.
Hi everyone, my name is Savannah Riesing and I'm representing the Minnesota Cup today. The Minnesota Cup was co-founded by Scott Littman and Dan Mallon of Magnet 360. This is its 12th year of the competition, and it's now being run as a program out of the Center for Entrepreneurship at the Carlson School of Management. This year we have over $400,000 available in non-equity seed capital to the startups that are applying. We also provide mentor matching events and business plan feedback for our semifinalists. So it's free to apply. If you're an applicant, you apply to one of 8 divisions, which include the clean tech division, food, general, high tech, life science, social entrepreneurship, a student division, and this year we just announced our youth division for entrepreneurs 18 and younger. The applicants are narrowed down over the course of the summer by our pool of judges. We have over 100 volunteer judges who are industry leaders and investors, and then they select the division winners, who each division winner receives $30,000 in prize money, and then a grand prize winner will receive an additional $50,000. There are only 2 requirements to apply. You have to have under $1 million in revenue, and you must be Minnesota-based. So our competition is attracting a really impressive talent pool of innovation and scalable startups, and our finalists have gone on to raise over $200 million since the competition began. The applications for the 2016 competition just closed, and we had over 1,500 applicants apply this year, with 38% of the businesses in the competition being led by women, and 1 in 4 businesses being led by a minority entrepreneur. So we're excited to see these numbers grow. We know that there's room for improvement, but we're excited to include a more broad talent pool. So we'll be announcing the 80 semifinalists in the 2nd week of June, and then the competition will wrap up during September in the Twin Cities Startup Week in that time frame. So I'll be back at table 11 if you want to talk to me afterwards. Otherwise, you can go to mincup.org if you're interested in applying to next year's competition.
Great, thank you.
Thanks.
It's been very fun for me to be a mentor for the Minnesota Cup for a number of years, and fun to have Savannah here. As she said, this year's event is closed, but as far as branding goes and get you up the curve for next year, please feel free to join us. Actually, we got to change of plans. Can you hold on?
Not next?
Not quite yet.
All right, well,
I told he's following instructions. No, actually, Steve Webster. Steve, where are you? One more prize in contest. We throw you a curveball there, Justin. Sorry about that. Come on up, Steve. So the Clean Tech Open, Steve Webster's got a couple of words to tell us a little bit about what's going on there. I've also been involved in that event, and tell everybody about the Clean Tech Open.
Yeah, thank you, Rick. Fantastic program, sold out, smart-looking crowd. Some of you look a little more tired than others, so I know deals are happening. You know, Justin will do anything to get 2 cameo appearances up here, so thank you, Justin. And love, love, love the Min Cup. I mean, I haven't seen any accelerator like that in America grow this fast and thrive. And the data that Savannah just threw out are pretty darn impressive. And if any of you travel the Midwest or America, find one that's better than the Min Cup. I challenge you. And they're just starting. So I run a quiet accelerator. The footprint's a little bit bigger. The Clean Tech Open is in its 11th year. Justin Castor, a prominent member of this business community, brought this into Minneapolis, Twin Cities, some time ago. It's currently sitting in the Schultz School of Entrepreneurship, University of St. Thomas. Been there 1 year to the day. We just, too, closed at midnight last night. That's why both Savannah and I look a little tired. Our application process, many of you in the room have probably been involved with the Clean Tech Open. By the way, if any of you have a company that doesn't think of itself as clean, get a new branding manager. You better be clean these days if you're going to produce something. Our footprint is a little bigger. We run a 13-state accelerator, much smaller, a little more focused. I have teams that are coming to the Twin Cities from Lexington, Kentucky to yeah, go Cats. You want to see a culture clash? Talk to somebody in Kentucky about coming up to Minnesota and starting up their business plan. We are not a competition, by the way. I mentioned a big footprint. Some of our teams that are in this year's accelerator are 1,500 miles apart. So it gets a little creative about how you communicate and how you help them develop their business plan. These are folks who have a great idea, professors who invented a drone and got $1 million from some federal agency to build their drone but have no idea what to do with it now that it's just perfect. So we sit down with them, mentors, many of whom are in this room, and work on that with them. It's kind of a challenge. It's in food, it's in energy, it's in information technology, it's in transportation, green building, you name it. Green is everywhere. I mentioned we're a little bit quieter. We do not have big prizes at the end. We do not take an equity interest. If you are serious about a viable business plan, and I know everybody in the room is, and you run into somebody in your line of work, they're coming in and asking for funding, and you look at their business plan, you go, oof. Or you're somebody with that big idea, but you don't have that business plan, give us a call. And at the end of the process, you will have a viable business plan. So Rick, that's what we got going, and thank you for having us today.
Thanks. You're over here. Again, for the contest prizes for both the Minnesota Cup and the Clean Tech Open, it was more about creating visibility and awareness for the audience, and if it works next year, it's a great organization. Thanks, Steve.
Yeah, and I will mention, if you're investors, we have BASF, we have Dow Chemical, they all come looking for that next portfolio company. If you're somebody like that, come on in and take a look in October. So get back to me, and in October you'll have a chance to meet these companies.
Great.
Thank you all.
All right, Justin. So we threw a little curveball at Justin, but he adapted great. Anyway, Justin is going to talk to us. Justin runs Essex Capital. He's going to talk to us about economic development. Justin and I have been interacting in the business community for a number of years. Justin helps folks find new homes, and when they find new homes, communities are often eager to have those businesses and jobs, and when they're eager to have those businesses and jobs, guess what? They help out financially and with space and all kinds of things. So tell us a little bit about your organization, Justin.
Perfect. Well, thanks, Rick. Thanks for the chance to be here. And I'm guessing everybody in the room is probably familiar with the phrase economic development, and presumably everybody's seen some article at some point, Business Journal, that talks about some company got financial backing, public incentives, et cetera, for growing their business in a certain community. What I find, however, as I get out and talk to companies is there's a lot of misconceptions. Well, that wouldn't apply to me. We're too small. We're not a big manufacturer, et cetera, which oftentimes none of those issues matter. Or companies say, well, would this apply to me, and how does it apply? And then second, I find companies say, well, what are these programs? What are the requirements? What do I have to commit to, et cetera? And then third, and maybe the biggest hurdle that I find companies face is, where on earth do you begin? Let's be honest, I work with the government, and so there's oftentimes too many cooks in the kitchen. And so there's a question, well, do I call the local community economic development office? How about the county economic development office? Well, maybe I should call the Initiative Foundation. Maybe I should call DEED. And so there's a lot of questions I find when I get out and talk to companies about simply where to begin, what applies, how do I go about this? And so assuming anybody can figure out something over a decade, for the last 10 years, that's what I've done, is help companies down the path of exploring if it applies. It doesn't in all cases, but I do see oftentimes companies that, if you're in the belief that incentive programs, government-based financing programs, et cetera, are there to not be abused, but they're certainly there to be utilized and used, that companies leave a lot of money on the table and a lot of incentive options out there because they simply don't know what to explore if it applies to them. And so that's my role, is to help companies down that path. Now, seeing that I pop $3,000 a month for daycare, I don't do it completely altruistically, but I am paid primarily by economic development agencies from about an 8-state area around the Midwest. And so they pay me to kind of complement their sales, marketing, recruitment efforts, if you will, such that I go out and talk to a lot of companies that otherwise wouldn't explore this. And so specific to this audience and the topic of financing today, a lot of companies will say, well, I don't need land in an industrial park. I don't need tax credits. What most aren't aware of, though, there's some very attractive grant programs, forgivable debt programs, non-bank lending programs that can be quite attractive both in terms of terms and conditions, subordination, et cetera. Yes, there are absolutely tax incentives, a lot of cost mitigation opportunities. And so are we moving around tens of millions of dollars? No, but for a lot of smaller, earlier stage companies, up to maybe $5 to $10 million businesses, we can certainly put together 7-figure plus packages. The challenge, I guess, is knowing where to start. And again, I don't have all the answers, but I can certainly help people down that path. And so for those who have any general interest, I'll be sitting back in the corner, or you're welcome to contact me after the fact. But again, encourage folks that say, well, maybe this could apply to seek me out. So thank you, Rick.
Great, thank you, Justin. Appreciate it. Okay, Patrick O'Shaughnessy of the O'Shaughnessy Family Office is going to tell us a little bit about the family office community. Appreciate you coming today, Patrick. For those of you who aren't aware of what a family office is, it's an organization set up to work with high net worth families and help them with a variety of financial matters, and sometimes those folks can invest. And Patrick will tell us a little bit about his firm and that marketplace. Patrick.
Great. Thanks, Rick, for having me, and nice to meet you all today. So Rick asked me to talk a little bit about family offices. Generally, it's a family investment company that's specifically managing the investable assets of a family, as well as managing some of their estate affairs and trust plans and so forth. As a group of family offices in the United States, there's about 3,000 in the single family office space, so it's a small group, but they control a significant amount of assets in the private equity, kind of spanning early stage seed, private equity, and venture. About $8 billion a year is deployed by family offices in the space. Right now, if you kind of look across the United States, according to UBS, generally the average assets under management at a family office are about $800 million. So on any given year, there's a lot of capital that can be deployed specifically into the private equity, venture, and angel investment space. Largely, larger family offices have professional staff, so it is just as competitive in the family office environment as it is to get capital, as Dave was saying, from the venture capital community. Very few deals are funded in the early stage environment by private equity firms, so it's highly competitive there. If you look about the philosophy of a family office and what are some of the advantages to having a family office investment, first and foremost, they're typically longer-term investors, and they're a more patient source of capital. They're looking to generally build a business, which is how their wealth has been created. They were entrepreneurs first before they were investors, and so they have a strong appreciation for what it takes to succeed and to build and grow, and they're looking first to build versus sell. Obviously, is something they look at in the long term, but it is not a driving motivation that you would find in private equity or venture, where they're looking for a 5-year, 7-year horizon for an exit event. So also, they're generally more flexible in their investment strategy and non-compartmentalized. So by compartmentalization, I mean, there's a box for private equity, late stage med tech. That's all we do. That's the only thing we do. Whereas a family office will look much more broadly at the investment potential of the company and be willing to invest in more broad-based areas. So the other thing is, I think family offices tend to focus on direct investments where they have a natural expertise or a core industry experience. Over multiple generations. It's something they know and understand. So when you're looking at the family office environment, one of the first things you're trying to do is find a family that actually is in your industry space, whether that's med tech or in our case, that's in the oil and gas industry. And generally, you're going to have a much better chance of securing capital if you fit their profile from a core industry background. a significant portion of family office assets are invested through private equity managers and venture capital managers. About 70% of all family office assets are managed through those types of investors. That said, 51% of all family offices make direct investments in early, seed to late stage. And so if you can find a way to get to a family office, there's a strong chance that they would make a direct equity investment. Typically, the best way to get to a family office is basically trying to find a network of professionals or trusted advisors that they're doing business with. As a given matter, only about 4% of investments made by family offices are on an unsolicited basis. So there's a little bit of a barrier to kind of gain access, but once you do, it's a very strong source of capital. Typically we focus on, long-term track records where people have been winners. We don't usually like to back first-time investors as a general matter. And about 46% of our investments are generally illiquid, kind of goes back to, long-term patient capital investors.
Great. So for the O'Shaughnessy, just to be clear, the O'Shaughnessy family office, oil, gas is your focus, primary focus, and then for other kinds of things, you're involved with Brightstone as well.
Sure, yeah. So our background is in oil and gas, as Rick said, so that's upstream, midstream, and downstream, as well as tech and services. And then as we kind of look, and all family offices do that, as we look to kind of diversify our investment base, we usually ally ourselves with venture capital or private equity firms. And so I'm with Dave at Brightstone Venture Capital that kind of fits our early seed stage investments for the O'Shaughnessy family.
Great, thank you very much.
You.
So Pat Dillon is up next. Pat is going to talk to us a little bit about the SBIR. Pat is at the Metropolitan Economic Development Association, otherwise known as MEDA, and Pat is a superb resource in the SBIR space, and any question I ever have about that category, I call Pat, and I've been doing that for a long time. So pleasure to have you here, Pat. Tell us a little bit about the SBIR.
Fantastic. Well, thank you, Rick, and all of the sponsors for hosting this great event. I'm frankly very delighted to be here. So, of course, my name is Pat Dillon, and I'm the director of the Minnesota SBIR STTR Assistance Office, which we commonly refer to as MN SBIR. So MN SBIR is focused on helping Minnesota firms compete and win federal grants or contracts through the Small Business Innovation Research Program and its sister program, the Small Business Technology Transfer Program. So I like an interactive audience. So how many have heard of SBIR STTR? It's a great source of non-dilutive funding.
Right. Mm-hmm.
So how much is available each year in SBIR and STTR? About $2.5 billion. And that's set across 11 federal agencies that issue what they call solicitations that include the topics or the research areas that they're interested in, and then small businesses, Minnesota, all across the nation, look at those solicitations and they decide to submit a research proposal in response to that topic. So what does that get them? For phase one, it can go up to $225,000 of funding to support that idea, that concept that they have. Phase two is up to $1 million, and sometimes with like the health-related med tech kinds of projects, it can be up to $1.5 million for the prototype development stage. And then phase three is where commercialization occurs. So all that I do is really focused on from concept to commercialization and using SBIR and STTR funding to help take those ideas and get them closer to commercialization. So what's really exciting for me about the SBIR program is we cut across all areas of science and technology. A big part of my job is to take your ideas and match them up with a federal agency that might have an interest in what you're working on. I spend a lot of time in that arena. And then, of course, helping companies with the whole process of actually drafting and submitting a proposal. This is hard work. It's competitive, it's complex, and sometimes it's complicated because it's federal R&D. So we send all our money to Washington. What do we do to get it back? We write really good research proposals that get funded. So what do our university researchers and professors do? They write research proposals to get funding to support their research. The same thing happens in SBIR companies, small businesses. So when I say small business, I mean from 1 employee all the way up to 500 employees. You can be a startup, you can bootstrap, you can go out and raise capital. I don't care what business form you've taken, but this is a fantastic source of funding. So SBIR has been around for over 30 years, and over $40 billion has been awarded to small businesses around the country. Now, there are some notable small businesses that got SBIR funding that are no longer small businesses. They're very large businesses. So Qualcomm, back in the 90s, got funding through SBIR through the National Science Foundation and DARPA. Symantec, iRobot. Here in Minnesota, we have Surmatics, we have NVE Corporation, Hyzotron, Data Sciences. There's about 150 companies right now that are actively involved in the SBIR program. What I love about the SBIR program is it supports the American dream. And for me, being very much a patriot, this is an important program for our country.
Great.
Now I'll get all emotional.
And also, thank you for your service as well over the years. So thanks, Pat.
Thank you.
Okay, the next up is Denny Campbell of the Strategic Business Group, going to talk about franchise financing. Earlier, we heard from Chris Simmons, who's involved with a number of different franchise organizations. Denny will tell us a little bit about the franchise financing world.
Thank you, Rick. Pat talked a little earlier about our Strategic Business Group company, and one aspect of that is franchise financing, and we've been in that arena since 2006. Franchise financing is, generally speaking, going to be an SBA product because of the risk involved. But in most cases, the lenders look favorably at the franchising because it is a proven business model. We end up with essentially 2 different kinds of franchisees. One would be the startup, the first-timer, and the second would be someone who wants to expand from 1 location to 2 or 3 to 4 or something like that. They fall in, from a financing standpoint, they fall into a slightly different category, each one, but in the final analysis, you've got to prove the same things. So for the startup, what we're really doing is evaluating them first from the standpoint, like the lender will. We're not a lender. We're going to go find a lender and get them excited about doing the loan. But we qualify them from the same perspective the lender will. First is, do you have the cash injection available for that franchise? That cash injection, Pat alluded to it, is probably somewhere between 15% and maybe on the really high side, 30%, but generally in that 15 to 25 range. The more funding you have, the more dollars you've got yourself, not necessarily for cash injection, but available, probably the lower the cash injection percentage you're going to have to do. Because the lender worries about what happens once you start, and do you have any money for speed bumps you might run into, that sort of thing. So first we qualify them for the cash injection. Secondly, if it's a startup, as I was talking about, then the lender is worried about whether or not they've got their lifestyle expenses that they can handle over the next 12 months while they get this thing off the ground. So that's the next thing we qualify them for. Make sure that they've got that. And lifestyle expenses can be rolled up with spouse's income and stuff like that, other investments, rental property, whatever. But we got to show that not only can they pay their lifestyle expenses without taking an inordinate amount of money out of the new business, but that they've got extra money left over each month to pay for those things that you can't predict. So once we've done that, then we work with them to put together a business plan and a pro forma financial projections, and we'll get the national numbers, the same ones that the lenders use, So in the specific category that their franchise is in. We'll help them put together the pro forma. We'll gather all the documents. Generally speaking, that's going to go into a 2-inch binder. But when we hand that off to the lender, it's going to have virtually everything they need in order to make a credit decision on that particular franchisee. The difference between a startup then and maybe the second or third location would be you've got to add in the financials from the first location, first or second, whatever, the other locations that the individual owns, so that the lender can be convinced that you're not going to take this loan out to rob Peter to pay Paul. So it's just a question of gathering the extra information, and they're a proven operator already, so that's a plus for them. So then we go to the lender and get them excited about it, and generally speaking, we can, at that point, unless something weird comes out of the closet that our franchisee hasn't told us about, they get the loan. We've done it for a lot of years. As I said, our referrals generally come from the franchisors, though more so these days. We're starting to get a lot of them in through our website. One of our franchisors we've worked with for 100 years, it seems like, but really since '06, is Anytime Fitness, and we've got a meeting out there this afternoon. Once a month they do a training class for new franchisees, and they force even expanding franchisees to either come back through their training class or else send one of their managers through that's going to manage one of the businesses. So we've got a session this afternoon from 3 to 5 out there where we present to the franchisees.
I'm going to jump in on you.
You got it.
All right, so Denny is over here at table number 15. Thanks, Denny.
Thank you.
Okay, Crescendo Venture Capital is a venture fund that I did some work with. They originated here, moved out to California. They have a sister group called Decathlon Capital Partners. They are doing revenue-based financing, kind of sits between your traditional bank financing and then the equity markets. What's interesting and unique about their loans is it's tied to revenue, and for an early stage company where revenues might be going up and down, they can fluctuate their payment stream. I'm here today just to put that information out there. They have some handouts that are over at the table, number 17 over there, 16, 17 over there. It's flexible. They don't put as many constraints as the banking world does, and they don't sit on the board like the venture world, so they're kind of a hybrid, a little bit more risk to their deals that they're willing to accept. And I've had a couple of clients get financing from Decathlon Capital Partners. Again, there's some materials over there if you'd like to learn more, or feel free to reach out to me and ask any questions that you have. Okay, our last two. The next one is securities-based lending. Ben Leistokow of UBS Financial and Eric Wenkus of UBS Financial. UBS did get a plug earlier. I think it was Dave Dalby who quoted a UBS report. So you got a plug earlier, second opportunity today. Ben and Eric, tell us a little bit about the security-based lending world.
Yeah, thank you, Rick. And I think it's safe to say that we're all here today because we like money, which is great. And we also like money when we can get it when we want it, and better yet, when it's non-dilutive and taxes aren't generated. My name's Ben, and this is my partner, Eric. We have expertise in securities-based lending, which essentially uses investment securities like stocks or bonds or mutual funds in your brokerage account as collateral or pledge for a loan, where oftentimes we're lending at competitive rates in the 3 to 4% range. This is great for business owners who have personal savings or businesses that have a liquid balance sheet. And one story with this is a business owner, a client of ours, who had a $1.5 million investment portfolio, and his business needed to buy a real estate property, but they needed to act quickly, and they needed really the money on time. What we did and structured for him was withdrawing from his securities-based line of credit. He lent that money then to his business entity, who was then able to make the purchase on the real estate. And then when the business had to pay back the loan, they paid back interest to the business owner, who was then able to the business then was able to take a tax deduction for paying that interest. And then Eric's going to talk about a strategy with a business.
Yeah, so recently we've had a fairly large deposit come in from a small energy company down in Dallas, and they were looking for very conservative investment portfolio. We put that together, and then took a look at their lending facility, which was at ING, borrowing somewhere right just south of 4%. Because of the size of their new account at UBS, we were able to lend at just under 2%, which is about a $70,000 a month savings in their interest costs. So we're sort of working through that right now. SBL lending is very simple. It's, portfolios in a non-retirement account. There's release rate that the bank, UBS, will put onto a bond, a T-bill, an ETF, a stock, and whatever that release rate is what the SBL line of credit availability would be. So it's fairly simple. There's very little credit checks. There's no balance sheets. It's just whatever is in the account. Non-retirement is what you can borrow against.
Great. Thank you.
Thank you.
So last but not least, Steve Wartleworth of Wartleworth Consulting. And Steve helps folks negotiate better deals with their vendors. And this was one that I was really excited about sharing with you today. I think it's a great tool to have in the tool bag. And Steve, tell us a little bit about how you work with your customers and how much money you save them.
Thanks, Rick, and appreciate the help of being the only thing between you and standing up and stretching your legs. I really upset Rick one day. So I want to talk about improving your cash from within. I hear a lot about borrowing money and taking loans and getting cash from banks, and my job is to stop my clients having to do that. We're going to talk about, most of my clients are manufacturing companies, and they're usually looking for cash for growth. So today I want to give you just 3 quick examples of how you can go about doing that. And I'll give you a couple of examples because I had a really special phone call with a client this morning on the way in today. So I'm going to give you some news about that. A privately held company I've been working with was offered the chance to triple their business from a very good customer. And because of existing debt, because of existing operational issues, they were ready to decline this increase in business. So I worked with them on the operational side on one side, but worked with them on inventory control, worked with their vendor who actually purchased all of their inventory back, left it on site, ran a vendor-managed inventory program, and the special news this morning was that they hit 72 inventory turns at the end of last month, which is almost unheard of.
Say that one more time so everybody hears it.
72 inventory turns. This company's turning over a little excess of $4 million, and they run $40,000 worth of inventory. Okay? And so this was a super special case. So we're going to celebrate that this weekend with the owner and his wife. And so, we changed some of the operational stuff, but most of it was working with their vendor, offering growth 3 times the business, and getting their buy-in as the vendor. A second opportunity, one of the biggest things I see in small to medium manufacturing companies is owners don't take control of inventory or their vendor relationship. And I really try and convince owners to manage that inventory. It's usually their first or second largest piece of money on their balance sheet, and they ignore it. They delegate it to a lower clerk, and they should not be doing that. And so we talked about moving one client from 8 turns a year, which a lot of companies think is okay, to 24 turns a year by managing and using some good tools and some discipline in driving their inventories down. The third piece where you can get your vendor to help If you want to grow, you don't just delay payments to them to use the cash. You go to the vendor and you explain that you want to grow and you need their assistance, and you'll give them more business. So I have another client where we literally asked for 2 extra weeks worth of payment terms. It related to about $100,000 being released in cash that they could allow to use for growth. And at the same time, they asked for support in marketing, promotion, and advertising in order to grow their own business. So both the supplier and the customer won out in both cases. So that was just three quick examples of how manufacturing companies can actually use the cash that's already inside their business. How many manufacturing companies are in the room today?
Quite a couple. Yep.
I won't ask you to show your hands, but if your inventory turns are less than a dozen, you need some help. Okay? And most manufacturing companies in Minnesota are well less than 12 turns a year. And so I will be at table 18.
18. Mm-hmm.
Use the cash from inside your business before you go out and borrow it. Way much cheaper. Have a great day.
Thanks. Thank you.